Good evening. Thank you for joining Corporate Connect, where we partner SGX Group to profile listed companies in Singapore for you. And this evening, we welcome Mr. Luis Estiandors, Chief Executive Officer, IREIT Global, as well as our audience from Facebook. We also welcome Mr. Geoff Howie, Market Strategist from SGX Group. And we will have hopefully an interesting time, Luis and Geoff. We will see how we can enthuse the crowd. We got a fair bit of crowd tonight. We will kick off today's webinar with a presentation by Mr. Geoff Howie, Market Strategist from SGX Group, on recent market highlights, followed by the corporate presentation, and that is by Luis, and we will end off with a Q&A session, gentlemen. Now, IREIT Global, which was listed on 13th of August 2014, is the first Singapore-listed real estate investment trust with the investment strategy of principally investing directly or indirectly in a portfolio of income-producing real estate in Europe, which is used primarily for office, retail, and industrial, including logistics purposes, as well as real estate-related assets. IREIT Global's current portfolio comprises 5 freehold office properties in Germany, 5 freehold offices in properties in Spain, and 27 freehold retail properties in France. So without further ado, I know you all are waiting to hear Geoff Howie. Over to you, Geoff.
Thank you very much, Mr. Gerald. I'll just share my screen and we're away. Okay. Okay, thank you. I intend to just take the next 10 minutes or so just to provide a quick overview of what we're seeing in our REIT market. Again, this is all an educational presentation, very quick one. And I guess what I'd like to share is that REITs continue to attract quite a lot of investment activity. The sector represents just a little over 10% of the combined market value or market capitalization of all our stocks that are listed on the Singapore Stock Exchange, but they do double that impact on a day-to-day turnover basis. So they represent around 20% of the $1.1 billion, Singapore billion dollars of turnover that we achieve every day in the Singapore stock market. And that is comparatively high too. When you think about it, there's one reason we are a very strong REIT hub, because globally, REITs are around 2% of the total market capitalization of the entire global stock market. And as we said in Singapore, that grows fivefold to around 10%. Also, when you look around the global stock market or look at the big FTSE EPRA IREIT global benchmark, the US actually accounts for a good 60% of that index. And that's predominantly because US REITs have been up and running for a good 60 years versus the 20 years or so that they've been here in Singapore. That global benchmark, the FTSE EPRA IREIT Global REITs Index, it generated a 3% total return for the first 6 months of this year. And that followed its 24% decline in total return last year. And this has coincided with persistent inflation in the United States and expectations that the Fed funds rate will be at around 5.25% to 5.5% when the Fed meets in the last meeting of the year in December. But looking back, extending through COVID years, so looking from the end of 2019 through to the end of June, that FTSE EPRA IREIT Global REIT Index has declined something like 9%, while our iEdge S-REIT Index has declined 7%, and that's total returns in SGD dollar terms as well. Now, those 3.5 years, 3.5 years, they were within a range. Those returns were pretty close, within a range of 5% to 10%. That's the global benchmark and the Singapore benchmark. And those two indices, they didn't average super strong correlation. There was a directional correlation with a correlation coefficient on average around 0.7. It does show that there is an element of differentiation in the day-to-day moves of both the global index and the Singapore index for portfolio managers. In Singapore, we are that global hub, and we have as many as 17 of our trusts exclusively investing in properties outside of Singapore, which, as Mr. Gerald mentioned before, IREIT Global is one of those. Its portfolio comprises, as we said, those 5 freehold properties in Germany, the 5 freehold office properties in Spain, and freehold retail properties in France. There's 27, which Lewis will be talking a lot more about very soon. We've also got 20 of the trusts here in Singapore investing in properties in both Singapore and outside Singapore, and the remaining 3 REITs invest purely in Singapore. We also have something like 14 trusts with properties in my home country of Australia. You have 11 trusts with properties in China, 11 trusts with properties in Japan, and then 9 trusts with properties in the US. So all in all, across our S-REIT sector, 80% of the trusts own and manage overseas assets from across Asia Pacific and the United States and Europe. And these S-REITs now, that makes us one of the most international REIT markets across the world. The average yield of the majority of the 40 trusts that make up the S-REIT sector, it was 8% at the end of May, while the yield for the iEdge S-REIT index stood at 6.4%. Singapore REIT and the property trust, they've also continued to diversify in terms of the asset mix over the past 3 years. Diversified S-REITs now make up the largest subsegment of the sector. More diversification can also improve a REIT's resilience to obviously external extrinsic shocks, and also allow it, I guess, to capture growth trends across not just one, but a multitude of segments. The 40 S-REITs, the 40 trusts that make up the S-REIT sector, they ended May with an average gearing ratio of 38.1%. That's below the regulatory limit of 50% if that minimum interest coverage ratio, which we spoke about last week, is at least 2.5 times. Now, for much of June, the 3 best performing trusts of our S-REIT sector, they included Lippo Malls Indonesia Retail Trust, Digital Core REIT, as well as Parkway Life REIT. So I'll just share my icon screen. Lippo Malls Indonesia Retail Trust, it, as we said, led the REIT sector for our Singapore REIT sector for much of June. It noted in its first quarter results before this that despite lower revenue and lower net property income, it did see stable operating performance across its 29 retail assets, given Indonesia had lifted all its COVID-19 restrictions at the end of last year. And it noted overall portfolio shopping traffic in the first quarter had recovered to something like pretty close, around the 80% level to pre-COVID levels. And it also added as well that active management of its tenants and lease renewals, or the tenant mix per se, and the lease renewals, had seen a renewal of something like 79% of the expired leases in the first quarter at a positive rental reversion of 3%. Digital Core REIT announced, remember earlier in June, that its second largest tenant, a global co-location and interconnection provider, had filed for bankruptcy, and the customer represented around 22% of annualized rent, and it's deployed across was deployed across 6 data centers that represented around 27% of the total portfolio value. Digital Core REIT did say that its distribution per unit could fall as much as 2 US cents, assuming annual revenues from that tenant was to be eliminated. However, the manager did note that it is expecting to be able to minimize any potential DPU impact, and it maintained and it was able to maintain or enhance its long-term value and returns for the REIT unit holders. And thirdly, that third stronger performer for most of June was Parkway Life. It reported some time ago 22% higher year-on-year gross revenue for the first quarter of this year, driven by higher rent from Singapore hospitals, plus the additional revenue from the 5 nursing properties that it acquired back in September 2022. They were basically the stocks that the REITs that took some of the spotlight in June, but we get very busy this month with the second half of this year, reporting results. We have as many as about 400 stocks, which includes a number of REITs that report their semi-annual half-year results in July, late July into August. But on that property acquisition front, I should also mention quickly that there were, for the first 5 months of this year, there were 6 acquisitions announced across the sector with a combined value of around 2.5 billion Sing. As you see, Maple Tree Industrial Trust in May announced the acquisition of a data center in downtown Osaka, Japan, that was valued at 508 million Sing dollars, and that private placement was 4.5 times covered at, I think it was $2.21 per unit, and that marked MIT's first foray into Japanese data center markets, and that obviously helps further diversify its portfolio. So post-acquisition, Japan would account for about 5.5% of MIT's portfolio by assets under management. So just to sum up, I'll take another 2 minutes. Maple Tree Industrial Trusts, as we said above, was this is my icon slide here, now has Japan representing 5.5% of its AUM. But I'll also note that its NPI, I think, for FY 22-23 was something like 518 million Sing, which was an increase of close to 10% year on year. And that, as they said, was mainly driven by a contribution of 29 data centers in the US, but partially offset as well by higher borrowing costs, okay? So just quickly onto that yield spread. Despite, I guess, this backdrop of increasing rates we're seeing, S-REITs are still offering higher yield spread of around 340 basis points above Singapore government 10-year bond yields, which are near 3%. And the last 4 years have also seen the FTSE ST REIT price to book index, or price to book ratio, I should say, which is represented by the green line in the far right, alternate a lot from a 20% premium to book value to a 20% discount to book value and back to around 8% discount at present. And that 0.9 times, I should say, back to a 10%, yeah, what I say, back to a 10% discount at present. So that PB ratio is currently around 0.9 times, which is around a 15% discount thereabouts compared to the 5-year average PB for our S-REIT index, which is 105 times, a 5% premium to book value. So just to sum up, S-REITs here, they offer one of the highest dividend yields still in the market and lower volatility than most segments of the APAC market. And we're also seeing a lot of passive investors basically show a lot more interest in this market. If you look at our REIT ecosystem maturing, our shelf of REIT ETFs, exchange traded funds on SGX, has grown from 3 ETFs 3 years ago with combined AUM of around 350 million Sing to now 5 ETFs with a combined AUM of around 870 million Singapore dollars. So I hope I've given it just a quick clear overview of what we're seeing in our market, some of the highlights from June, and I'm going to stop sharing because I'm really looking forward now to hear more about IREIT's portfolio.
Hey, one question.
Yeah.
You're optimistic about the market for REITs?
Yeah. Yeah, I mean, well, retail has been. Retail continue, the sector continues to book net retail inflows. And we are, I think, known in Singapore for the retail side of it, David, to be value investors or deep value investors. Right. And they have continued to be buying, not maybe at a lesser pace than we saw last year, but retail continue to buy. Yeah.
With COVID and with Ukraine war and the rest, having a slight dip on the returns.
Absolutely, there's not like a flood of retail market money going into the market, but it's almost like a cautious flow. A more cautious flow, but still, it is the sector is booking net inflows from the retail market so far this year.
The REIT market still.
Yeah.
Okay, I'll let you go.
Thank you so much. I'll be listening. Thank you, sir.
Thank you very much. That was Mr. Geoff Howie from SGX. Now, let me call on Mr. Louis Dawes. Mr. Louis Dawes will now do the presentation for you. Thank you, Louis.
Hey, hi, David. So let's start. Good afternoon or good evening, everyone. Very happy to be with you and, to illustrate some of the comments and information that have been given by Jeff before. And I think, IREIT, is a good example of, high dividend yield with pretty low LTV. So that's something that can be, pretty attractive to investors. So, we're going to take, you through this presentation, which is basically put together while we are currently, performing an acquisition of a retail portfolio in France, which is 17 retail properties, as we did, in 2021 when we acquired the Decathlon portfolio. It's pretty similar assets in retail parks, 17 properties which are led to B&M. B&M, you might not know them, but B&M is a leading discount retailer in Europe. They are listed on the London Stock Exchange in 2014. And they are currently part of the FTSE 100 index with a market cap of 4.7 billion pounds. So pretty big tenant. The acquisition crystallized an initial net property income of 7.9%, which reflects an acquisition, a DPU acquisition or accretion rate of 0.6% based on the pro forma adjusted 2022 figures. Last but not least, and that's a specificity of IREIT, we've got two sponsors, so we've got a unique positioning. We've got Tikehau Capital on one side, and we've got City Development Limited on the other side. Very complementary sponsors, and they are taken fully their pro rata plus CDL, City Development Limited, is covering a portion of the excess. So a strong, alignment of interest with all unit holders. So if we go on the next slide, which is the presentation of the portfolio in greater details, you can see that the portfolio is across, France, as we have, for instance, with Decathlon. So it's units, 17 units again across the territory, all fully let to B&M, 100%, with a WALE of 6.8 years for a total price of 76.8 million euros. If we go on the next slide, we're going to have a presentation of the enlarged property portfolio post-acquisition with a valuation for the portfolio which will be above €1 billion. This acquisition would increase the occupancy rate from 87% to 88.8%, would also increase the WALE. So again, something which is pretty positive from a diversification and from a stats point of view for the REIT. If we go on the next slide, that's more a track record, on IREIT. And I think here we wanted to show you all the things that have been performed over the last 3 years, 3 to 4 years. So inception with the IPO in 2014, it was, initially a portfolio of 4 up to 5 properties only in Germany. And since, 2019, with the arrival of City Development Limited, there has been a strong push between Tikehau Capital and CDL to develop the REIT and to diversify the income of the REIT. So there has been acquisition of 4 properties in Spain, then 5. And then we have this acquisition of retail units led to Decathlon in 2021. So we had at that time 37 properties. And now we are offering, we enter into a sale and purchase agreement for this acquisition of 17 properties in France led to B&M. So we would have a total portfolio of 54 properties. So really diversifying the portfolio and not to have, in a way, all the eggs in the same basket. If we go on the next slide, let's present you here the rationale and benefit of this acquisition. First of all, we're going to talk about, the asset class, retail. Second thing, we're going to talk about the tenant. Then the quality of the portfolio and its potential, and last but not least, the benefit on the overall IREIT portfolio. So let's tackle with the asset class, because we consider retail is something which is very interesting currently. Maybe just few numbers here, and you can find this presentation on our website, obviously. But maybe let me highlight you 2 numbers first here on the 2 first bullet points. The first thing is, retail parks and out of town retail is basically this kind of asset class that you have just on the outskirts of city centers. So people are going there with their car, they park in front of the property and then go into the shop. This asset class, has attracted a lot of investors, real estate investors over the last years because there has been a repricing. So if you look at, for instance, on the first bullet point, you can see that the retail investment volume has been, 20% higher than the 5-year average. And if you look at more specifically retail parks, so this asset class that we are contemplating here, the investment volume is 75% higher than the 5-year average. So in other words, there is a strong traction from real estate investor into this asset class. And how do we explain that? It's just, all the repricing on the retail already happened. If you look at, the yields and the pricing of retail assets, they are very attractive compared to other asset classes because all the e-retail, e-commerce already happened on this asset class, and it has also finishes with COVID. So in other words, you can find very attractive yields in this asset class. While we consider that in the future, the success of retail parks will continue due to low rental cost for the occupiers and a very attractive products for the customers with low-cost retail brands such as B&M, such as Decathlon, and especially in this kind of market where you've got strong inflation. Last but not least, there's something that we like also about this asset class, and especially in France, there is a scarcity of land to develop. And there are more and more laws which are reducing the availability of land to develop this kind of assets. So we consider that this asset will continue to increase in terms of value for unit holders. If we go on the next slide, and that's something, that is showing the resilience of this asset class during the COVID. And if you look at through the lockdowns, you can see that, for instance, on lockdown 2 and lockdown 3, these assets continue to attract people because they remain open, because it's open air format. So you park in front of it and you go into your shop and you go out. It's not a shopping center where there are galleries and corridors and a lot of people, and it was actually closed during COVID. So there is a kind of resilience in this kind of specific situation of COVID. And we consider that this momentum will continue and will continue to grow. Because it is sedentary consumption. It is people living around, going into these kind of places. It's not dependent on tourism or population movement, you see. As I was saying also before, the second point is on the fact that, it is many low-cost brands which are very popular, especially in this kind of market with high inflation with customers. And last but not least, obviously, all operating expenses and rents are pretty low compared to what you have in shopping centers. So for all these reasons, we consider that retail is something, and retail parks is something that will continue to perform in the future. Now we talked about the asset class. Let's have a look on the tenant itself. So some of you may know B&M. So as I was saying, B&M is a leading discount retailer in Europe. They are listed since 2014 on the London Stock Exchange with a market cap of £4.7 billion. They have over 1,133 stores, mainly in the UK, and they are expanding currently in France. Maybe just one simple number is, if you look at the sales growth, overall, since 2019, their sales growth has been above, 12.6% year on year, which is pretty phenomenal. And we consider this will continue. If we go on the next slide, you can see the sales, for instance, on the graph for France. So if you look at, for instance, on the chart on the right side, the sales in France for instance, grow by 9.2% between 2020 and 2021, continue to increase by over 14% between 21 and 22. So, very strong stats, because in this kind of market, we consider their products and their positioning is really good. It's a hard discount retailer, you see. And all these numbers, and we can go to the next slide, is related to this kind of strong fundamentals that you have on the discount retail industry currently. Few numbers here. If you look at, the third bullet point here, what we say is that between September 2021 and September 2022, there has been a 24% rise in traffic at discount stores. So it does represent more or less in France 1.2 million new customers. And this has driven, a growth in number of stores that have been opened within the 6 leading discount brands. It has, they have increased the number of stores by 33%, you see. So that's something, again, very positive, and B&M is well positioned as a leader to benefit from that. So we talked about the retail assets or asset class. We talked about the tenant. Let's have a quick look on the portfolio itself. Maybe a few things here. First of all, is there's one tenant, but we have one lease contract for each asset. So it does, diversify our risk. Second thing is all these leases are indexed annually, so we would benefit, from indexation. If we look at, for instance, the Decathlon portfolio, since acquisition, the rental income that we are receiving for Decathlon has increased more or less by 6%, you see. So we would consider B&M should follow the kind of same trend. Last but not least, all the costs related to gas, utility bills, and all this are covered by the tenants. So in other words, the costs that remain with the landlords are related to structural capex, you see. So that's something important in this kind of markets where there might be, some inflation in terms of utility bills. Last thing that we like also about this portfolio is the potential upside through development. So there are two folds here that we like. The first one is potential income coming from, car park spaces with, putting in place some electric charging station. So that's something that is not taken into account. And the second thing is the potential development that we can add on some asset that we're having. And we consider that we've got untapped gross floor area of around 5,000 square meters. So that would potentially generate additional income. So now let's have a look on the overall portfolio of IREIT, how it makes things evolving. It would increase, the portfolio asset value by 8.1%, gross lettable area by over 16%. This would have, if we look at on the next slide as well, a strong impact in terms of continuing the diversification, with France representing 27% of the overall portfolio, reducing exposure to Germany from 59% to 52%, increasing retail from 13% to 20%, and increasing as well, the mix from a trade sector point of view. So that's something important for us, is continuing this diversification to allow resilience of IREIT income, you see, for unit holders. And if we look at on the next slide, we can see that B&M would enter in the top 5 for the top 5 tenants, sorry, after Deutsche Rentenversicherung, Deutsche Telekom, and Decathlon. So that would be something pretty positive for unit holders. If we look at on the impact as well from an income point of view, we would move, from 50 to 56% the income where there will be a lease expiry beyond 2028. So it would add, some further visibility on the income that we have within IREIT. Last but not least, one thing which is also important for the management is to increase liquidity on the shares for unit holders. And we consider that by adding, this portfolio and having a capital raising, we are able to increase the market capitalization of IREIT. Here, it will be an increase by 14.4%. So that's something important to reach, some indices and to create the liquidity that is required for the investors. All this obviously, is feasible thanks to the two sponsors that we're having. So again, a unique positioning on one side, TKO Capital. Hello?
Yes, we can
Yeah.
hear you.
Can you
Yes.
hear me? Super.
Yes.
So on one side, TKO Capital, which is headquartered in Paris, which is an alternative asset manager with a local expertise, people on the ground, so to manage, locally all the assets. And on the same time, we've got, City Development Limited that is providing a strong financial support to IREIT, and obviously which is headquartered in Singapore. So all this is very complementary, and especially because CDL, they have also a strong expertise on the European real estate. So we consider that something that is creating, a strong alignment of interest with any of our unit holders. On the funding structure and financial impact, so what we are currently doing is we have launched a preferential offering, and Kevin will give you a few details on that. So we got a total acquisition cost of 90.9 million euros, and we would fund this acquisition cost through a mix of debt, external debt, and also capital raising. And if we look at, on the next slide, the impact of this capital raising, we would have an increase of the DPU of 0.6%, while, the net asset value would decrease by 7.4%, and that is mainly given due to the discount that is offered to investors to subscribe to these units. One thing which is, last but not least, but which is something which is very important currently, is about, LTV and aggregate leverage. Within IREIT, we would remain with an aggregate leverage which is very low, if I may say, from 32% currently to 33.3%. So there will be a slight increase, but this would remain one of the lowest within the SREIT market currently. I will stop here now, and I will pass it on to Kevin to give words and few details on the capital raising.
Thank you, Louis. So my name is Kevin. So I'm helping on with the investor relations and capital markets. So maybe let me quickly go through the key details of the preferential offering. As Louis has mentioned, we have recently launched the equity fundraising via a preferential offering to raise a gross proceeds of around 75.9 million Sing dollars. And that is on the basis of 161 preferential offering units for every 1,000 existing units. So the issue price is at 40.8 Singapore cents, and that represents a 9.6% discount to the VWAP. Essentially, I think, which Louis has earlier mentioned, TKO Capital, City Developments, being the joint sponsors of IREIT, have provided their undertaking to subscribe for their pro rata. And in addition, City Developments has also gone ahead and to provide their commitment to subscribe for assets such that the total amount would be up to Singapore dollars 40 million Sing dollars. I mean, together, the joint sponsors and the manager would subscribe up to 82% of the preferential offering. This, in my view, really represents the long-term commitment and the confidence in the growth prospects of IREIT. So the gross proceeds obviously is used to fund the acquisition for this portfolio of 70 retail properties. Maybe just quickly go through the indicative timetable of the preferential offering. quite a few days has passed. I think we have already determined the eligible unit holders for the preferential offering. And in fact, yesterday, the preferential offering has also been opened for subscription by unit holders. And the closing date for the preferential offering will be on the 11th of July. That's next Tuesday. And unit holders, if they are interested, they will be able to subscribe for their pro rata entitlements as well as for excess units. So the everything, if goes well, will be the issuance of the units will happen on the 19th July. So that is another key date for unit holders to take note. So with that, I quickly pass back the mic to Louis, who will provide some concluding remarks on IREIT.
Thanks, Kevin. So, I mean, as a conclusion, maybe just four things on this, new acquisition. Obviously, the idea is to get a bigger exposure to an asset class that we consider attractive and resilient, which is out-of-town retail. Second thing is, gaining an exposure to a strong tenant, B&M. Third thing is obviously, the quality of the portfolio, which is located in established retail parks with a potential upside income through developments. And last but not least is, this aspect as regard to continuing the diversification of IREIT's portfolio, which is very important to enable to have a DPU increasing in the future. And to provide resilience to investors on the DPU. So I will stop here for now, and I will pass it on back to David. Many thanks all.
Thank you, Louis, and thank you, Kevin, for your presentations. Let me start with the serious concerns that have been expressed about. Actually, the concern is about the rights issues. Their concern is, what is the management's approach to reinvigorate the company given its lackluster performance after 3 rights issues in 5 years? Are you creating value when rights issues are undertaken at increasingly lower prices? What's the risk of non-renewal? And the third one on rights is, how will the impending rights issue affect the NAV, DPU, and outlook of IREIT in future? What is the growth plan for IREIT? Would DPU payment frequently be changed to 4 times per year? So a number of questions, all relating to, rights issues. How is it going to impact on them? What value are you creating? Is it going to affect the DPU? Over to you.
No, thanks for that, and I think that's a pretty fair question.
Yeah.
So I think what has been difficult is obviously we have performed some rights issues, and we've been impacted obviously by all the situation afterwards with COVID. All rights issues have been performed so far with an oversubscription. So I think that's something that has been seen positively by the market. But obviously, IREIT, as most of the REITs have suffered from the situation of rising interest rate and a share price that was declining. So obviously, if you look at currently, the discount between share price and NAV, you are around 40%, which we consider is not justified in a way. So we consider that the share price of IREIT, represent an attractive yield currently. So what I can say is obviously we've been also able to collect 100% of our rent, even during COVID. We've got an LTV which is extremely low, at 32%. That was what we were mentioning. And all the benefit of what we are doing and implementing now, which is a kind of diversification strategy, the benefit of that should be seen in the coming months and years and in the future. If I take just a simple example, but more or less 40% of the income that we have currently within IREIT was not there 3 years ago, you see. And when we have, for instance, a building that has been fully vacated in Darmstadt by Deutsche Telekom, if we would not have done this diversification policy before, this would not, I mean, the impact would have been much greater, you see. So we consider it's important to continue diversification. So like that, it will create some value. But unfortunately, it's true that, I mean, we've been in a market that has been pretty challenging with interest rate rising and a share price, therefore, that has declined, you see.
So the immediate good news that you can give these troubled IREIT investors, Louis, that be patient, how long?
I mean, I'm not heading the European Central Bank,
Yes.
but it's true that, you know, we consider that we would benefit from inflation on our rents, you see. So if I take the example of B&M, it's, you know, one of these assets where you've got annual indexation, you see, and you've got, you know, a granular portfolio. While before we had, you know, initially just 5 assets in one same country and in one same asset class, you see. So I agree. I mean, and I understand the frustration from some of our investors on this. But if you look at, you know, the dividend yield that is offered, I think it's still, you know, attractive, you see. So it's just that we are going through a market from a share price point of view, which is tough, and I understand that.
And that is due to a number of factors beyond your control.
Yeah.
And this is the ones that are happening between US and China and Ukraine and you know, slum in the office markets, quite a number of factors, isn't it? So you are hoping to come out of this the next 2-3 years?
I think, I mean, what we are focusing is on what, as you say, I mean, what we control, you see. So it's, you know, increasing the occupancy rate,
Yes.
Finding opportunities that are, you know, creative, doing
Yes.
the capex that we have to do to have a portfolio which is from an environmental point of view certified, you know, all these kind of things that enable to continue to attract tenants in our property. So that's, you know, our focus on a daily basis.
Yeah, the retail market has, not only in France and Europe, but also in this side of the universe, has been affected. Retail markets, you know, and people are doing online and not, you know, much physical visitations to, you know, the companies, the blocks, the buildings. So they are asking, retail space, whilst retail is suffering from more online sales, what is their long-term view from your take? The long-term view.
That's very interesting, because I think, you know, if we consider all the things that we could do online,
Yes.
I would stay, you know, on my sofa every day, and all the time, 24 hours, 7 days a week. So in other words, I would, you know, order my food online. I would work from home. I would shop online, and I would stay home all the time. But we consider that, you know, people are social animals, and they need, you know, to test products.
Yes.
And for instance, it's really depending on what is your tenant, you see. I mean, Decathlon, for instance, you know, it's an experience. You're going there, you test the product, you see, you like to touch it. So for me, the reality is in between. It's what we call phygital. It is a mix between digital and physical shopping, you see, and it works together. If we take, for instance, B&M, the positioning is slightly different. B&M, it's a hard discount retailer. So if you want to benefit, you know, from an attractive price, you have to go into the shop, you see, because the price of getting a delivery is actually around 20 or 25% of the cost of the product, you see. So it's far too much, you see. So people are going into the shop to benefit from this offer, you see, and they would not get that online. It would be more expensive. So I think, I mean, it's just a question of which type of retail, and it depends really on, you know, the retailer that you have in your premises.
Yes. So you have covered, maybe from this question, you have covered diversification as a strategy. All right. You're saying that, look, there are factors beyond my control, but there's still the worry of your worry for your, retail, the investors, is that you have a track record now of decreasing DPU over the past several years, as well as the share price. Both have been dipping, not drastically maybe, I think, for enough to create concern. So the justification from you has been the need to diversify and acquire more buildings to reduce concentration risk. Now, whilst the AUM and income increases, managers' AUM and income increases, the shareholders, they say, this question is from a shareholder, suffering capital and yield declines. And when will this, therefore, the trend change such that we can see a predictable increasing DPU and share price? Be an astrologer for a while.
Okay, not an easy one. I think, if we look at, the dividend currently on the dividend yield on IREIT, you've got a dividend yield which is around, 8%, you see. So, that is pretty attractive. But I think, what we are doing here is what we were discussing before, but we're going to get the benefit of this diversification strategy in the future, and thanks to inflation, and hopefully, the share price is something that will follow afterwards, you see. So I think at least, we are in a position where, again, we've got visibility on our debt cost over the long term, and that should give, confidence to the investor that we are in a position where we can continue implementing our strategy without being in a position of, suffering from potential increase of debt cost in the very near term, you see.
And you also have a local property developer showing confidence in you.
Yeah.
So that's an insurance, isn't it? But can you advise on existing, this is another question, existing or long-term shareholders, dilution in SG REITs, when REIT issuing more shares to grow portfolio?
Sorry, I'm not sure I get the question.
So he wants advice from you on the existing or long-term shareholders dilution in SG REITs, but is maybe broad, but let's confine to yours. When REITs are you issuing more shares to grow your portfolio?
We are definitely, here, for instance, we are we have launched a preferential offering, because obviously the idea is to do this acquisition of and fund this acquisition of BNM portfolio. And then, as also what we did is we launched last year an EMTN program, so a medium-term note program, to be able to issue some debt product, you see.
Yeah.
Then I think, it's a question of finding what makes most sense given, the market context for investors in terms of how to fund potential new acquisition, you see, through cost of debt, through capital raising, but at least, we are creating this potential option of also using debt instrument to actually fund some new acquisition.
So, Louis, another shareholder is saying, look, the company is doing everything it can to improve its occupancy rate going forward. You're also buying properties so that they feel it will impact on your fee. Your fee will increase. Buy more properties, you should be focusing on trying to fill vacancies. So again, coming back to their concern, will all this reflect on their DPU?
Absolutely. So I think I think it works both ways.
Yes.
So you need to work on, the portfolio itself. But just if I take, one, that's, numbers we presented before. It's actually on a slide, Kevin, if you want to put it, it's on slide 19.
Yes.
If I look, the exposure to the German portfolio, the German portfolio is still, 59% of the income of the property of the REIT, you see. So I think you need to work on continuing this diversification. And so, through this acquisition, we will move from 59% to 52%. So you need to do that. And the fees that we are getting as a manager is a portion of what is distributed to the investors, you see. So there's a strong alignment of interest as well as regard to the fee for the manager, because it's a percentage of what is distributed to the unit holders, you see. So we need to work on filling the portfolio, but having, also more assets, you see, and decreasing this exposure to German properties, you see. So that's what we've been able to do starting in 2019, you see. And so if you look at here, the enlarged portfolio, you've got more or less 48% of the income that would come from property that were not in the portfolio before.
Yes. So some investors, some of your unit holders asking, are they right in thinking you're shifting from office direction to a retail direction?
I think, not really. I think, retail has been always part of the potential, of the strategy with logistics as well. It's just a question of, finding deals which are attractive from a return point of view, you see, for the investors. So I think, as we were saying before, retail has been through a repricing already. While logistics, is going through that currently, or office is going through that, but the yields on the logistics or on the office side are still, very limited or very low, you see. So we are expanding on the retail side, but we hope also to add some logistics asset at some point, you see. It's just a question of, of finding the opportunities which from a return point of view are attractive for the investors, you see, because we are hearing about, obviously, about, concern of investors on the DPU.
Yes. Louis, you have Spanish acquisitions, and I think you would agree that the Spanish acquisitions have been performing not up to expectations, somewhat poorly. But are there plans to divest these assets and recycle capital into better performing assets?
So I think, so far, maybe just one thing is, I would say that, occupancy rate on these properties have increased since the acquisition on the Spanish portfolio. If you take the Spanish portfolio, occupancy rate has increased. So that's really the first thing I would like to say, because obviously it is something which is positive. Second thing is what do we call not performing? We have received 100% of our rent during COVID, you see. So I think we should not be ashamed about it, you see. Then I think in terms of arbitrage, and last but not least, in terms of valuation, the properties valuation have also increased, you see. So I think from an income point of view, occupancy rate has increased, valuation has increased, and we have collected all rents, you see. So I think, it's a kind of performance in a way. Then, in terms of arbitrage, that's obviously something that we are looking at, because as a REIT, we need, at some point to have some assets, when we have implemented the asset management strategy, is to sell some of the asset and then buying others. So that's obviously something that we have in mind. But in the current market, also, you need to be cautious on, value for the investors. And currently, if you look at the market, it's true that investment or the liquidity of asset has lowered, depending on which type of asset, but maybe more on the office sector. So that's something you need to, let's say, to monitor. But you don't want, to sell or dispose asset in a market where you cannot get, the best value for the investor. So I think there's nothing which is rushing us to dispose some of these assets, but it's obviously something that we are looking at on a regular basis and reassessing.
Good. Can you comment on for this investor, or provide some update if you can on the upcoming expiration of Berlin campus in 2024?
Yeah. So we are currently, discussing with the tenant. So what we like with Berlin is either, with the existing tenant, or or a potential new tenant, there is a strong value to unlock because there is a strong under rent. So that's basically something which would be positive for the investor, is there is some strong value as regard to rental income, or the value of the property itself. So that's something we are assessing with the existing tenant, discussing with them, while at the same time looking at a potential repositioning on a multi-let basis, you see. So, but again, it's there something where we can create value for the investors.
So the next two are tied up together. Any comments from you on the future workforce dynamics in Europe, such as more prefer to work online than going to office? Is the company therefore at risk of having a run like what's happening to the US commercial risk REITs?
Yeah, I mean, the market in Europe is slightly different from the US REITs. There are some similarities, but they are also different in the sense that infrastructure and commuting to the office, the time to commute might be shorter depending on where you are, but in the places where we are, usually it takes less time for people to go to the office than what you have in the US. So we consider that people, obviously there are some trends of work from home, definitely, but companies consider that it's still very important to have some office space to gather people, to put people together, at least 3-4 days a week. So office, and it's like retail. In a way, retail has been through digitalization over the last 10 years. Office is going through digitalization now, but office is not dead. We will still need to go to the office to meet people, to interact with people, and it's not the same than doing that online, you see. So we are still very positive on the office sector. What we consider is the assets which are not well connected would suffer the most, because obviously the demand for office space is lower and will be lower, but to an extent which is not as if office space would disappear tomorrow. Definitely not.
Yes. Louis, can you comfort those who are nervous about the riots in France now? Is there any risk that your France property could be affected by riots?
I mean, I knock on wood, but touch wood, but I hope not. I think, I mean, it's not the first time that there are riots in France. It is, in very specific location, very concentrated places. So we consider that, I mean, that's something that should finish pretty shortly. And obviously, we've got insurance and policy, insurance policy in case if there's any issue, you see. But so far we consider that is a short-term effect that hopefully should be finished pretty soon, with the government that is acting pretty actively on the ground.
Well, a few more questions have come in from shareholders. You're very popular tonight, Louis. Okay, here is the next one. Your cost of equity today is roughly equal to NPI of the assets being acquired. So the only benefit to shareholders is diversification, especially since DPU is more or less flattish and NAV drops. Appreciate your thoughts on this.
Yeah, so I mean, I hear it. It is, great to look at the DPU today, but what is important is to look at, also growth in the future. Because if you look at, things as a snapshot, I mean, it's too. We should not draw conclusion too quickly on this. You see, so yes, it is maybe flattish today, but obviously, what we were saying before is, the rent will be indexed annually. See, so that's something important to create, the future growth of the income for the investors.
Okay, thank you. Why don't you look at disposing underperforming assets or placement to rejuvenate the portfolio instead of consistently doing rights issues, inclusive of dividends calculated. The loss on investment is about 20% over the past 5 years. Is that correct?
I mean, I don't have, the specific this specific number in mind. What I would just say is, and that's what I was mentioning before about, this investment is also, there's investing in a market where we give the right value to the assets, you see. I think there's no benefit for the investors to sell or to dispose properties in a market where the appetite, for instance, for office asset is not as it is usually, you see. So I think we don't have something which is forcing us to dispose of these properties today or tomorrow. Let's make sure, we can maximize value for the investors, you see.
So we have come almost to the end. Thank you very much, Louis and Kenny. Yeah. Thank you very much to both of you, Kevin, for taking questions, appearing on our Corporate Connect program. It's been revealing, entertaining to some extent, but sometimes worrying too. I wouldn't like to be in your shoes, Louis, at this moment, but we'd like to see you again. And perhaps with better news. You're working hard. I can see that your team is working hard. We hope the assets will perform and the DPU will increase, improve. That's all they want. They want better DPU and long-term investments. Thank you very much for coming tonight. But for the investors who have appeared on our show tonight, Eileen has an announcement to make. Thank you.
Thank you. Thank you, Mr.
Thanks,
Gerald.
Solom.
Thank you, Louis and Kevin, for the insightful sharing. I think the unit holders here benefited very well during the Q&A session. So without further ado, I just want to highlight that in case you missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. And of course, Corporate Connect is a monthly webinar. Do visit our website to get updates for upcoming investor education program and initiative. Right now, I think maybe I just urge everyone to just type in the chat box to let us know which listed company you like us to feature. And of course, the upcoming Corporate Connect will be featuring Centurion Corporation on the 11th of July at SGX Auditorium next week. So without further ado, thank you for joining us this evening. We hope you find that this session is useful, and we look forward to you joining us again. Thank you very much.